All right, we are live. Hello, everybody. Welcome back to Palantir Weekly. This is episode number 104, and we are live for the first podcast of 2024. So super excited to be here. I am here with myself, Arnie as well. Matt should be joining soon. Vince unfortunately couldn't make it. We'll see if Matt joins in a bit. But we do have some juicy drama to talk about in regards to the analyst downgrade that we got today. So they gave us some content to talk about in a
What's
week.
investing without drama?
Yeah, it's. I mean, the week was kind of boring, to be honest, for Palantir. I mean, there's definitely like little itty bits of piece of news. But in terms of the big juicy piece of news, we got Brent Thill. I keep confusing with like Thiel, like Peter Thiel. I keep like
Don't do that.
Yeah, I definitely don't do that. So we're going to be talking about him. And then on top of that, we're going to be talking about our 2024 expectations. This is the first podcast of 2024 for Palantir Weekly. So I'm sure Arnie and I have a bunch of different ideas and expectations we have for 2024. We'll be discussing that. We're also live on X. So for those that are joining on X, thank you for joining. And yeah, I think you can still comment on StreamYard, and we'll see it on the StreamYard that we're at right now. Before we get into it, Arnie, how are you feeling to start 2024? S&P's down a little bit. Santa Claus rally kind of fell off. Overall sentiment around the market right now.
Well, the sentiment overall, I would say, is obviously greedy, but it is very greedy compared with last year. But it's not because everything is really hyped. Actually, it is more a comparison stuff with last year, which essentially this period last year was very depressing. So in relative terms, everything now seems super hyped. But what I see is that things could actually improve. So in the general market is like, you also mentioned that there is demand. So the market is quite hot, but we are not in a phase where I would say, okay, we are in hype, everything risks crashing down heavily. Like that can always happen, obviously, but I don't see probabilities really going against our favor. And what is peculiar is that typically Palantir having a high beta, meaning that it is relatively more volatile than the market, should follow the market, but with a superior effect, meaning the market goes up, Palantir goes very up, market goes down, Palantir goes very down. And actually what we are seeing is market going relatively well and Palantir, vroom,
Right.
which actually makes me very interesting.
Why? Why is that interesting?
Because look, if there is high demand that is not translated into hype, that means that from my speculative point of view, it is only a matter of time before people who are greedy to get into the market want to pursue something that is going to be disruptive. And day after day, week after week, we have been seeing this AI narrative that seems something far away in the future initially. Like I think when we started investing in Palantir, we invested because we saw, oh, this software is actually very cool. This AI stuff that they keep mentioning seems the future, but that future seemed quite far. At least I would have said, oh, this stuff will be really relevant in 5 years, something like that. Meanwhile, I expected things to gradually evolve. While what we have been seeing, thanks to ChatGPT, OpenAI, on all of this, is that all this timeline that in my mind was in 5 years' time is now. And we are only seeing the beginning of this. Here I'll talk in a more speculative way, but have you noticed that now McKinsey dropped an 80 pages AI research? BCG, Sachin shared a great post showing how generative AI is expected to grow at around 60% CAGR for the next 5, 10 years or whatever, driven mainly by healthcare at 80% CAGR, where casually Palantir is really investing a lot in healthcare. So this to say, when you have McKinsey, BCG, so Bain will eventually come as well, because when the key consultancy say something, you can stay behind. Then this creates not only more interest, but this, in my view, also creates a sort of self-fulfilling prophecy. Let's say, if everyone thinks this trend will be the future, but nobody is really actually deploying money to that, that stays there. But now, when you have the interest that is high, you have the consultancy companies basically pitching companies, hey, you should take care of this because this can be transformative for your business. Then you have CEOs actually deploying this money into this AI stuff. And if CEOs start putting more money into AI, then usual use cases started to emerge. Imagine, imagine if everyone in the world would see the output that Palantir has been generating with AI to its client. Like, imagine, like, tomorrow everyone is aware. Wouldn't all the CEOs at least, 30% improve in efficiency? Let's try.
Right. No, I agree. I agree 1000%. I thought your analysis on the healthcare part of that made a lot of sense. And the general market seems to be not declining as much as Palantir, and that probably speaks to the delta or the opportunity right here in terms of the lack of discovery the market is having in terms of Palantir's AI, healthcare opportunity, all those different verticals, and the actual share price. Now, granted, we do have a high multiple on the stock, and that is where we get into the next topic, which is our good friend over at Jefferies decided that he was going to downgrade Palantir today. Here is what Jefferies said. He has a price target of about $13 on Palantir. He says, we are still fundamental fans and believe that the company has the potential to gain share in an underpenetrated and large TAM, but think concern over top line growth will be the primary driver of stock performance over the next 12 months. He noted that the AI story around Palantir is likely overdone. He conceded, however, that the company offers a highly differentiated platform that companies can use their specific data analytics needs. The key issue, though, is whether it can get out of its own way, as it has faced some execution problems in recent memory. Final quote, Palantir has faced some execution issues over the past several quarters with growth stalling in both its government and commercial businesses. We believe that the key debate is focused on whether Palantir can solve its go-to-market problem and re-accelerate U.S. commercial growth. My raw thoughts on this, and then Arnie, I want to hand it over to you, is that I did not think this downgrade was incredibly unfair, because I think the argument he's making around the multiple being too high, given the lack of growth, I think that's reasonable. Where he got 13 from, not really sure. Why is it in 14, 15, 12? A lot of times we have no ideas for this. The thing that I thought was very weird about this is that this argument is being presented at the beginning of the year. You've got earnings in about 60 days, maybe less than 60 days, and definitely less than 60 days, probably going to be mid-February. And on top of that, when the stock was running to 21, this analyst did not say the argument that it's not like anything changed from when the stock was 21 to when the stock was 16 outside of the stock price for why their go-to-market strategy is flawed. And obviously, if you think it's flawed at $16, it's definitely flawed at $21. The multiple is just egregious at that point versus at 16. So from my perspective, the way I interpreted this was he did not want to seem wrong at $21 when the stock was running and put out this report, because then if the stock doesn't tank, he loses all authority as an analyst, because the goal of an analyst is to pretty much say something and have an effect on the market to like redeem their narcissistic ego of them having an impact on a stock. You can't do that when the stock is rallying, right? Because if you do that when the stock rallies, you look like an idiot. But when the stock is down 40% and now you just pile on to the downside, now you look kind of smart, especially if the stock continues to tank, especially when you're addressing something that management knows has been an issue. It's not like Karp is hiding the fact that their go-to-market strategy has not been strong. They've been changing it with that bootcamp strategy, and in a couple of quarters, we're going to see if it's paying off. So what were your raw thoughts to this analyst report? Do you think there's any legitimacy towards it? And do you think there's an argument he's making around go-to-market that ultimately makes sense?
I would say there are many points here. I just listened to the interview that was published on YouTube Finance, where he explained more the reasoning behind these reports. And his words are essentially, we under.
Should I play it real quick, Arnie? It's like 1 minute. Should I play it?
Yes.
I have it. Let's just let's listen to him for about 1:30, and then we'll discuss.
By Brent Thill, Jefferies senior analyst. Thank you for joining us, Brent. So talk about this note here and this bearish stance that we started to see that really in sort of mid-November regarding Palantir and this euphoria here. But what brought you to this decision?
Yeah, we think Palantir is a fundamentally amazing business. We're talking about the stock, and the company stock had a huge outperformance last year on the hype of AI. And I think what we're seeing is AI is a driver, but it's going to be a slower revenue materialization to the overall impact of the story, and many stories, including Microsoft and others. So we are huge fans of what's going to happen due to AI. But again, as we said, that the hype is ahead of the reality. And we think, again, the stock, given the magnitude of the outperformance last year, we simply just like other names in software, like Monday.com, Microsoft. There's a handful of others that we like better. So it's a relative call. It's a call that, hey, stock had a huge move. There's no smoking agenda here in terms of something that's happening that we detected or field checks or any of that. That's not the case. The case of this is just more of we like other names better. And this was one of the top performing names last year in the software industry.
Go ahead, Arnie.
If we could synthesize what he said in one sentence, he said, we downgraded the stock because it has gone too up. And we essentially say the company is now worth less because it has gone up, because his previous target price was $18 and now is $13. I think I've never heard something more stupid from an analyst. Because if you also compare it, like I saw his previous target in 2021 was $30. He almost saying that in 2021, the company deserved to be almost 3x what it is now, while now is worth less. And in my opinion, I would say it's quite the contrary. Like it was in 2021 that it was at the early stages, and now they are not only proving the value proposition, the financial numbers actually work well, but they also show that they can shift the company internally very fast by not only increasing the profitability, but also while sustaining growth. Like this component alone, to me, is very precious, saying if you have a company that while reducing cost, increasing the margins, can actually start accelerating, there you have something very good on. And what he says is, this story is overhyped. We'd better focus on Monday and Microsoft and so on. So he's a relative, like he says this is a relative play, but his assertions, rather than making me scared, makes me confident that I'm not wrong in adding.
Yeah, I think his point, and we'll get Matt here in a second, was he does not think there's anything fundamentally wrong with the AI component of Palantir or like their AIP or their differentiating moat, but rather the go-to-market sucks. And it's just weird that he's saying it now versus, months ago.
I agree with you that the timing was not bad, but I would say very suspicious, because you should say that something, hey, look a second, is overhyped when it is actually overhyped. But now, making this report that is quite bearish, and at the end of the day, $13, $15 is not that much. Like potentially, it could do like that difference in positive or negative in a couple of days, and we have seen that.
Matt, your thoughts on the downgrade? And hello.
Yeah, and I think you guys are going to probably drag me through the mud here when I say what I say. I mean, I don't think that this is too much different from what many of us has been talking about. I've been assuming that there was going to be a recent pull or an upcoming pullback in the stock, and I haven't changed that opinion. And I wouldn't be surprised if it gets down to $13. I think that people need to take these sorts of things with a grain of salt. I mean, they're short-term price targets. He's not talking about 5 years down the road, 10 years down the road. He's talking about where he sees it in the shorter term. And so with that, I think you need to recognize that with a macroeconomic pullback of say 5-10% of the market, I could easily see this thing getting back down to the 13s. Not too long ago, Arnie sold in the 13s. So I think that instead of, blaming and pointing the finger, because right now we think that, it's always up and to the right, I think what the analyst said was actually something that was very truthful. The company underlyingly is performing extremely well. I think what he stated was he just thinks that the valuation needs to grow a little bit. You have to think it was up over 150% last year. It has an opportunity to pull back, right? I think that we need to be a little bit more realistic at the end of the day. And I don't think he's saying that it's going to zero. I don't think he says it's going to stay at $13 forever. I think we just need to take it for a fact that what he's saying is what it is. And at the end of the day, could it pull back to $13? For sure, right? But it doesn't necessarily mean that it's not going to go back up to $20, $30 in the next 5 to 10 years. So I think people just need to calm down a little bit. Don't lose the long-term vision, and really just truly take opportunities like this as it may. I don't think that you'll get very many opportunities for the stock to pull back 20%, 30% very often. And if that's the case, you get to see a blip of it here. Take advantage of it. And, I think that $35 billion market cap is still very healthy for the company.
I
right?
agree.
It's different, right? I think a lot of people are still losing the fact, and I'll leave it this little last 30 seconds here. I think a lot of people neglect how much share-based compensation has truly been out there. The float of the stock has gone up by over 50%. $13 of 18 months ago is not $13 of today. $13 18 months ago was worth probably in the $45 billion market cap range. I'm sorry, less than that. It was $13 of 18 months ago was worth way less. It was probably worth in the $20 to $25 billion market cap range, because there's only 1.5 billion shares outstanding. Now you're sitting here at, say, $13 billion, and you're looking at a $35 billion market cap. So it's a very different space, because there's been so many more shares that have been put onto the market just based off of when the stock was down, at 10, 15, $10 billion. So anyway, I would just take this opportunity to recognize that this is an opportunity to buy if you're long-term. And that's what I'm looking to do. I'm hoping it gets down to 13. I'll buy more stock.
Mm-hmm. Amit, you mentioned something in your post that made me think that, look, if now it is only a problem of valuation, because this is essentially, imagine this way, this analyst is quite skeptical on the valuation and the go-to-market. If given these two components, he still comes out with a $13 price, that essentially means that even for a bad case scenario, these $13 could act as a support, theoretically. It's not saying, if you take his words only, oh, this company is overhyped, we don't like the go-to-market, and he had a price target of 8, would be different.
Right.
But given this, a non-excited analyst having a price target of $13 is essentially a signal, okay, we are already digesting quite a bit of pessimism. I like to have a sense of analyst estimates when I look at the stock. And this is something that personally makes me excited, because what I learned is you need to have a sense of what analysts say to compare the story you see in your mind to what analysts see. And by looking at the estimates, I shared a couple of weeks ago that analysts still expect in aggregate the revenues to keep growing at around 20%. That to me is already a hint that there is upside potential, especially if the current trend keeps going on, because we have been touching a very low revenue growth, but every quarter now we are getting that 2-3% acceleration. And by the guidance, we should be already at 20%. If this trend continues, and I think it will continue, analysts will have to revise these estimates. What I'm noticing, like if you can share the screen, please.
Yeah.
Is that now we are expecting not only the margins to stay very high in terms of free cash flow, but there is also the basis to let also the bottom line expanding. This driven by more revenue growth, but also by the interest component and the efficiencies triggered by the bootcamps, because essentially bootcamps are a very efficient way to grow. And if we look at these numbers, we see that in terms of operating free cash flow, operating margin adjusted, the analysts expect the margins to stay stable just below the 30%. What caught my attention was this component of the net margin overall, where analysts expect essentially the net margins to stay in around the 10% for 2024, and at most 14% in 2025. This, to my eyes, is a hint that potentially analysts here are underestimating what Palantir has been doing. Also because if you keep piling up cash, you have a lot of interest that just adds to the net margin component. So by combining the revenue growth, which 20%, in my opinion, is underestimating what will happen, and maybe with the new quarter, they will adjust. Also, on the bottom line, I see some space for the upside. So now the multiple is around, like the valuation multiple is around 40 x free cash flow. 50, depends really how precise you want to calculate it, which is rich, but is not expensive to my eyes compared with all the dynamics. So I see a lot of space for revision, both for the revenues and consequently also for the free cash flow. What do you think about this?
I agree with you, Arnie. I think the net margin, I think, is going to be much greater than what they're predicting. 10 to what was 2026? Would it say 13%?
2025, 14%.
Yeah, that's too low. I mean, you think about it, the ops margin itself is 80%, right? So that gets you that, and then, or the gross margin is 80%. Then when you have the EBITDA margin, it's closer to 30%. Like, I think you should be tracking closer to 20% by the time 2025 rolls around. Is it going to hit 20%? Probably not, right? But I think 14% is still an underestimate.
Yeah, I know I would tend to agree as well. I think the other big thing is their operating margins increasing just because the business becomes more efficient and they kind of iron out all the kinks of it. If that happens and the growth gets back to that level that we want it to get back to, you know, it's going to be fine over the next decade. Here's a question for you guys. And Coach Rap said this in the chat. We need 30% growth to like reasonably justify these multiples. And I know if we don't get 30%, it's still somewhat justified, right? You can make these arguments. But like if you have 30%, no one could really make the argument that Palantir is overvalued. Do you realistically think this year we can get back to 30% if you had to put, you know, percentage odds on it? Or do you think it's going to take another 2 years to get there?
Who starts?
Matt, you can start.
Okay, I'll start. I think it's going to be quite difficult to reaccelerate to 30% unless there's some sort of large deal that comes through. And, you know, it's quite possible that you see a good opportunity if, I mean, you have the NHS deal, which came through, right? But that's only a 5% uplift, 4% uplift comparatively to where they were last year. The analysts were kind of expectations from what Arnie just pulled up assumed about a 20% year-over-year growth going from 2.2 billion to 2.65 billion. I think that that's appropriate for now. I think maybe they'll get to 2.7, 2.75, but to get to 2.8, 2.85, which is that 30% growth that you guys are looking at, it's going to require a lot of big contracts to be signed in pretty quick succession, right? Because we're already in 2024. So it's going to be pretty tough. I mean, I could see us getting to the 2.65 mark pretty easily. But getting closer to 2.8 is going to require some big deals. And I hope I'm wrong, right? I would love to get back back to that. But I think just how the business model works, I think it's going to require getting to 2025 before we truly see the impact of AIP.
Arnie?
I'm quite aligned. I would ask Matt direct question to what he said. The NHS deal is expected to contribute, let's say, 35% to the revenue growth. Do you think that was already implied in the guidance?
Likely, because I still think that Palantir anticipated to get closer to 20% this year in terms of year-over-year growth. They haven't explicitly stated it, but I'd anticipate that they come back this year in the February timeframe, and we look at the fiscal year 23 and then go forward to the 1Q and also fiscal year 24 kind of guidance, that they'll probably be aiming at a 21 to 22% year-over-year revenue growth. That's just my anticipation. I would be ecstatic if they start to aim north of 25%. I just don't think that we've established one quarter of kind of bucking the trend of downward revenue growth, going from 13% to 16% sequentially in 2Q to 3Q. And so it's hard for me to say, okay, we're going to go from 16% back up to 20, 25% throughout the rest of fiscal year 24, right? It could easily, go back and stay flat at 16 or maybe go to 15%. So, it's hard to be able to kind of see that trend change that quickly. But I would love to eat my words, I'll say, right? I'm very optimistic about the company long term, so I would love to eat my words. I just think the short term is going to be tough.
Well, just to contextualize this is what we mentioned previously, that after a long period of declining growth expectations, we are now at the second quarter, given the guidance of an acceleration. I personally expect this acceleration to keep increasing gradually during the year for multiple reasons. The interest in AI, and now we know that they have this ability to close good deals relatively fast, so that really helps the demand. But there are also other dynamics like the potential Titan that should arrive in Q1 that would contribute potentially. We have the NHS that I think could contribute as well. And there is a more technical aspect given how you calculate percentages. So far, our results, especially on the commercial side, are dragged by the SPACs, which rather than contributing positively to the revenue growth numbers, were contributing negatively. And now we almost reached a bottom from where it is very hard to go below. This means that when we will calculate the percentage variations year on year, next year, the SPACs will hardly contribute negatively again. At least they don't contribute, but if they don't expand, but hardly they will not contribute negatively. So given these factors, my personal expectations is that we will see something like now 19-20% growth, then a couple of percentages more, then a couple of percentages more, and reach something closer to the 27-30% by the end of the year. This is what I personally expect, given while also having an option of potentially, let's say, other big deals arrive. Palantir unlocks the full potential of the partnerships thanks to CodeStrap. Something like that, when there could be a hint that potentially we could see more acceleration. And there is another fact that is connected with something I shared the other day, that so far we have been hinted for a 29% EBIT adjusted margin. But if we contextualize all the information we have, we know that so far Palantir has been providing software for free to Ukraine. So far, we know that Palantir just launched this product, and when you launch a new product, you are more prone to say, okay, let's test it for 6 months, 12 months, we know that Palantir is very used to say, take this software, use it for free. And we know that so far, Palantir has been running a lot of NHS Pro pilots. We know that from the disclosure around, but also that was backed by Ether Square links. So if we combine everything, we know that this marginality that we are seeing is potentially underestimating the true numbers. So I see a lot of potential also there. Like by combining everything, it's like even if you keep the margins at 29%, if your natural margins would tend higher, that would mean that you have more marketing budgets to spend that could support the growth.
Yeah, I would agree. To the question that I asked as well, in terms of 30%, I agree with you, Matt. I think it's going to be really hard to do that. We got a coach up in the chat that says if they don't deliver at least 30% growth in the race to adopt AI, I would be shocked. AI can grow the bottom line, and that's really what matters, especially to the PE that is setting up to get slaughtered. If they don't get to 30%, it's going to suck. But I realistically, I agree with Matt. I don't know how they compound enough deals to be able to get to that number. Now, maybe there's stuff where and we know there's all those deals out there, so it is theoretically possible. It's just a question of if they're going to be able to do it. On top of that, if boot camps actually prove to be the winning go-to-market strategy, and we'll know by Q4 how much of a winning strategy it is, we can reasonably project if they'll get back to 30%. But if we don't really see increased customer count this quarter, next quarter, or at least Q3 of 2024, it's going to be hard to imagine 30% happens by the end of the year.
Yeah, it's going to be tough. And the share price, I think, is kind of reflected, right? I'm just looking at it. I'm going to toss some pie in the sky numbers. I'd love to get Arnie's opinion because he's really good with this stuff. And the whole thing that I'm looking at is say you do get to the 20-25% growth range and you end up at about a 3.1, 3.2 revenue in fiscal year 2025, so not too far away. So we're talking about the next 24 months, we're going to be able to grow to 2.65, then to 3.1, 3.2 billion. You have that adjusted EBITDA margin of around 30%. You're going to walk away with close to $1 billion in EBITDA, which is actually pretty reasonable if you think about it. So if you put a 30x multiple on that and just recognize that the company is still growing 20-25% going into fiscal year 25 to 26, and you just put a 30x multiple on that $1-ish billion of EBITDA, from a fiscal year 2025 perspective, the stock is okay priced, right? Like if you think about it in that perspective, right? And some people might argue, they might say, well, 30x multiple on $1 billion of EBITDA is a little bit expensive, but you have to think this is a very premier software company, right? And there's not a lot of shit like this out there. And it's a very, the hype, I think, is real with respect to the AI perspective. So to me, I'm okay paying 30x of a potential, premier sort of company like this. So if you think about it, then, so in terms of if they're able to meet this 20 to 25% revenue growth, get this 30% adjusted EBITDA margin, which isn't far off from what Arnie had on his graphic, then, going into fiscal year 26, if they're able to grow that again, then you're going to start to see that, okay, this price here at the, say, $13, $14, $15 range is actually pretty damn cheap if you start looking 5-10 years down the road, and they're able to maintain even just a 20% growth rate. Because you're able to compound that, say, to 20-25% at the margins that we're talking about. If they're able to get that to 30-35% ops margin, and then also get the net income closer to 20-25% when it's all kind of said and done. I mean, that's the thing I think people are kind of discounting the most, right? The margin piece is also going to help, because we're kind of in a discovery territory with respect to this. Like, are we going to end up in the 25% net income margin range, or what's the deal with that? Because if you think about it, you don't need a lot at that point. Let's just take, for example, you get to $10 billion of revenue, let's just say in the next 10 years or so, you're walking away with, on an ops margin basis, 30% of that, 35% of that, you're looking at $3.5 billion. Put that and multiply that by, say, the 30x, right? You're talking about $100 billion market cap, right? We're at 35 billion right now. So that's a 3x within 10 years. So And that's not to say, the AI capabilities, other software components that come out, the more important, the longer that Palantir is out, the more defense contracts we get, right? So I don't think that, where we're at and the numbers that we're seeing are bad. And I just want to reflect, like, you don't need to get to 30% to eventually get to the end goal. And I guess just sometimes don't lose the forest of the trees. I'm not saying you guys are. I'm just maybe providing a little bit of a light and shedding some numbers. But that all being said, I want to hand it to Arnie and really see what he's thinking with respect to the stuff that I just said.
No, I'm absolutely aligned. I think you came out with great points. And that's my personal expectation and my personal feeling. When the stock was at around 21, that was implying already substantial expectations. And we have to think that when you buy a stock at multiple, essentially you are hoping that multiple at least to stay at that level so that you capture the growth of the business. Right now, the multiples are around 40 something x free cash flow, which seem high, like compared with many numbers that we have been used to see, like the big tech and so on. That number is relatively high. But think this way, and that's the framework I'm having. Having a around 40x free cash flow for a business that grows, let's say 25% to have an average between the 20% expected and the 30% dream, that is actually already very good for a business that has recurring revenues, no debt, no whatever. Also keeping this in mind, if Palantir really wanted to grow the numbers with $3 billion in cash, they could potentially buy stuff, be super aggressive on marketing. So that is all optionality that if Palantir wanted really badly to push growth above the sustainable growth rate, they could do that. They don't do that because they are extremely conservative and they want their clients to sleep well. So that becomes goodwill. So the bottom line to me was at $21 per share, given the developments that we were having, was a price that I was not happy to add because that was already implying relatively high expectations to my view. At this point, I would say the price seems to my eyes fair or even cheap because at let's say at their normal expectations, analysts are expecting 20% growth, 40x free cash flow. Given these margins, given the long path that potentially this company can have, because here we are not talking about, let's say, end phase benefiting from lower interest rates. So until you have low interest rates, you have hyper growth. Here we are talking about a secular trend that potentially can be very, very long. And Palantir is set perfectly to benefit from that. Execution risk, clearly, but potentially they could do that. So even with these base expectations, 40x free cash flow, given, as Matt said, a pristine company like this, no debt, very high margins, the ability to keep innovating products without making M&As like Snowflake, that is already a good price. Let's say, given what I said previously, when you buy a stock, you assume that at a multiple, you assume that multiple to stay flat. And if that happens, you capture only the growth of the business. So let's say from now on, the stock market closes and we just have a fixed free cash flow multiple of 40. What we would get is 20% revenue growth. So if the margins stay flat, we get 20% every year, which is already more than 2x the S&P 500. But we also have a potential further margin expansion, which could make the free cash flow grow relatively more than the revenues. So given this, I say this framework makes me think, okay, this valuation is fair or even cheap.
To wrap up the conversation around the analysts, I do think it's important to stress one more time that he does not have a problem with the core business, and he said that verbatim. He has a problem with the go-to-market. It's not easy to build product. It is relatively easier, even though it's still hard to fix sales. So again, I think we're in a good position. I made this point today on my market open stream. I feel like every high growth tech company struggled with the high growth part in the beginning, right? In Amazon 2014, the argument was they're not growing. Tesla at one point was not really growing. Netflix was not growing. Apple right now is not even growing, and they have a 30 PE. So every high growth tech company, before they broke out and their stock broke out as a byproduct of them breaking out, they had to figure out the high growth part of the tech. And I think we are all here as investors in Palantir because, Palantir going from 35 billion to 70 billion and getting a double is a little bit easier than Microsoft going from 3 trillion to 6 trillion. So we're taking a better or a differentiated bet that's a bit more risky, a lot more risky than just betting on Microsoft, even though you can own both, that Palantir will figure out the high growth part of the business, which will justify the tech multiple that they get because they figure out high growth. But that's why you invest early, right? It's not easy to be a high growth tech investor. The growth has to be there. It has to line up with the multiples. And sometimes the multiples are there, even though the growth is not. And that's what presents these opportunities where a stock can get overvalued, which we obviously saw with Palantir back at $21. So if they figure out high growth, if they figure out sales, and we're here watching them on this journey and supporting them to figure out that high growth part, then the tech part's going to take over, and we should get a stock that has some awesome multiples on it. Go ahead, Arnie. Go ahead.
No, I was going to say that essentially Palantir is trading very close to Costco again.
Right. And obviously Costco is not a high growth tech company, right?
And the potential is very, very different. Okay, there is a premium for Costco because it's considered super safe. Also, there are super recurring revenues, a lot of like earnings compounded, the management super brilliant. But this, how at least to me, gives a sense of, okay, potentially the free cash flow multiple on Palantir, if the 30% growth is confirmed, until getting confirmed 30% growth, there's a lot of time. But let's say at the end of 2024, we are very close to that 30% growth, or at least there is a lot of substance hinting, okay, 2025 will be the year. My expectation that a multiple of 40 would be very cheap. So I would expect, personally, I like to think in terms of free cash flow growth versus the free cash flow multiple, which is a valuation framework similar to the PE relative to growth. It's not really the same thing, but we can assume that they are very similar. And you want to have a fair consideration is a 10% growth with a 10x multiple. If you have a 20x, you have a 30%, a 20% growth, 20%, 20x multiple. But the reality is that growth dominates the multiple. So in the reality of real companies, real valuations, if you have a company that grows 30%, you pay more than 30x. You pay 50 because there you have a premium on the stability if that growth is steady and strong. Obviously, easier said than done.
Right. Question for you guys. Do you think at these prices they should deploy some money on the buybacks?
I personally would, but go ahead.
I don't think so. I think that they still need to worry about getting themselves into a place where they are able to generate closer to $1 billion of cash first. So I would anticipate I would not be buying anything until 2025 timeframe. I'd like them to see and establish about a $700 to $750 million adjusted free cash flow next year. And then by 2025 timeframe, get closer to 950 to $1 billion like we discussed. And if that's the case, and the reason being is I have some reason behind this, we're on let's just say right now, we're probably going to get to 600 or so. My numbers are going to be off by 100 million plus or minus here, but 600 million or so in terms of kind of adjusted free cash. With that, you're distributing about 125 million a quarter in share-based compensation. So roll that in a trailing 12-month, that's going to be 500 million a year. And so at the moment, if they were to deploy any cash towards buybacks, they wouldn't necessarily be able to kind of keep up with the share-based compensation piece. In a couple years' time, that $500 million a year, which I suspect will sustain going into the future, maybe come down to $400 million a year. But once you get to the $1 billion a year sort of free cash flow perspective, which is going to start probably closer to next year or early 2026 timeframe, you're going to basically have the ability to buy back all the $400 million worth or $500 million worth of share-based compensation every year, and get to a place where you're actually having leftover cash, and you're not spending 100% of your free cash, right? So you're actually going to be only spending less than 50% of your free cash on these sorts of things. And so to me, that's much more safe. And I think at the moment, we still need to build the treasury a little bit in order to maybe get a little bit of net interest income on the money as well. So I think it's still too early. I think the cash flow is still a little bit too small, but growing as expansive as we are will be very quick. It'll show up within the next 24 to 48 months, I'm sure.
Arnie, your thoughts?
I start from the premise that I was very skeptical when they announced it. I was actually roasted by Jeremy because I said they should never do that, and they announced the buyback. They didn't execute the buyback, and I would say it was rational and good not to execute the buyback given the price and the compounded value that was at that point. But at this point, I would say things are quite different. Like in these last 6 months, the stock price has been essentially flat. Okay. But what's the compounded value of these 6 months? In my opinion, very high. We know that AI is not only hype, but there is real demand. We know that we got some interesting deals like UniCredit and some other stuff. But more importantly, we got the NHS deal. We know, like, we have further confidence that the defense world is not only thinking of, oh, maybe one day we will need AI, but they are definitely starting to see that as a real need. So this changes everything. Would I buy back aggressively? Absolutely no. But I would say I would be happy if I were, let's say tomorrow I'm the CFO, I would at least start the buyback. And I say this because buybacks are effectively an investment the company makes. And you want the company to actually understand well how these dynamics work. Otherwise, you risk doing the worst thing ever, like Facebook never doing a buyback. Then they started doing a buyback when the stock was relatively expensive, when the stock crashed, and they didn't buy back. You need to learn as a company, unless you have a super crazy skilled CFO like Apple, how to perform this stuff. Because buybacks can destroy value or generate value for shareholders. So personally, I would start, but I would start very small. Let's say with the interest income you get from the cash, that 150 million cash you get from the cash, rather than having more cash piling in, I would start this process of buybacking, especially given the considerations that we shared in the last minutes. The valuation now is not high, and potentially if Palantir were to be bought by another company, the valuation would be extremely higher. Look at Snowflake, how much they paid for these acquisitions. We don't know the precise numbers, but I would say they were probably way higher than a 40x free cash flow. Sorry, if I want to point out something that CodeStrap mentioned in the comment. He shared this comment that was interesting. Sorry, I lost it. Okay.
It's the one about
Uh,
pilots.
There were something about okay, Palantir is monetizing AAP. Trust me, I have the receipts. Not only it is driving Foundry adoption, but you are paying them for the compute and storage. This is an interesting information that we didn't get. They just aren't carving out a new license fee yet for AAP features in Foundry. I don't know exactly how to read this. So
CoStep said this a while ago, which is that the only way to use AIP is to be connected to Foundry. So you kind of have to have both, of my understanding. You can't really have AIP independent of Foundry. At least that's what CoStep said, I think, a month ago. So you're paying for compute and you're paying for storage with AIP, which means you have to be paying for Foundry to an extent. So they're definitely monetizing it. I just don't know if they're monetizing it to the extent where, you're charging the couple millions that Karp was talking about on top of Foundry.
So it's like you're like paying a Foundry plus the additional compute.
Plus the module of AIP. Plus the module of AIP, yeah.
But you're not paying for that module for AIP currently. Something like that.
I think you are. I think that's what CodeStrap is saying. That when you have Foundry, you have to buy Foundry. And then one of the modules is AIP, which is, we're all thinking it's like this big platform, but it's a module inside of Foundry that is a platform in and of itself. And then as you use it, you pay for it. So the more shit you ask the LLM, the more it charges you, via the storage or via the content.
Correct. I can confirm, right? So I open my Foundry instance at work, and with that, there's a little bit of a button. You can choose Quiver, which is time series data. You can choose Fusion workbooks, which is kind of like Excel and what have you. Then you have Contour, which is kind of like your pivot tables and stuff of the like. And then there's a little AIP button, which unfortunately every time I click it says you do not have access to this. But it still shows up and says contact your system administrator, your Palantir administrator to be able to get access to this. And unfortunately, it's under the same sort of thing, right? It's just a little application that would show up underneath your operating system, right? Just like you would open up ChatGPT. You would just kind of go to a Google Chrome instance and open up ChatGPT, and then that would allow you to access Twitter or Instagram or Excel or something like that, all from that ChatGPT instance, right? So it's very much like a prompt in that respect. And unfortunately, I don't have as much experience with it, but just based off of what I've seen in terms of the demos as well as the actual it showing up in the background, I just don't have access to it. It's there, yeah, and it's not any different.
You see, CodeSwap, the comment highlighted by Amit. You buy Foundry, you get AAP. You pay for the storage and compute. Basically, you pay for the storage and compute, the additional storage and compute that AAP generates, but you don't pay for AAP module per se. So this intrinsically is aligned with what I shared previously, that we are having these numbers without really having that add-on on AAP, which I call the AAP pilots, because Palantir is not really monetizing on the AAP component. So let's say be broad, 6 months, 1 month, or 1 year of these modules that now is given internally as an additional module for free. You just pay for the compute, but that doesn't go to Palantir. That could mean that we could see the monetization of AAP as a module in 1 year. Make sense?
Right. Yeah. And then he says right here, the pilots I am running are 4 to 6 weeks with a pre-negotiated conversion. So XYZ company negotiates before the 6-week pilot starts that we are going to buy AIP, Foundry, whatever. If this goes well, then 6 weeks, that's about a month and a half. You do it. If the product works, you convert them, and then boom, you got a client. And so look, if that's really scaling, we're going to get to that 1,200, 1,500 customers by 2024. If it's, kind of scaling, we'll be lucky to get to 1,000 customers by end of 2024. Right now, we're at 453. But that conversion, that customer count growth rate has to go above 8% next quarter because it's been kind of stuck at 8% for the past
How
2 quarters.
many bootcamps have we made so far? Like in
440, something like that.
Okay, so let's approximate 500. And let's say that some of these bootcamps were already done with existing customers. Like the first, I think, 100, 200 pilots, bootcamps were probably done with existing customers. So let's say the capacity of managing bootcamps so far is approximately 1 1,000 per year, potentially. So also that adds to the potential revenue increase.
Yeah. No, it's a big deal. And Coach Rep says, now imagine I can scale that model across 100K person plus consultancy. Dude, it's a big deal. I mean, that's where the PwC Accenture partnerships make sense, but it really is a question of, can you actually scale that model of 4 to 6 week conversions across a very wide enterprise? Because if that's the case, we know they have a top tier product. Then it's just a question of converting.
Could you explain this comment? Like,
So
I
basically,
struggle to understand it.
imagine. So he works at PwC. I would imagine, we're just going to use his example, 100,000 people at PwC would all be working to sell Palantir, right? Or Foundry to an extent, right? So now you've got all these cohorts of different groups of people working in energy or healthcare or whatever it is, saying, hey, let's run these convert. You're not going to convert all these pilots, right? So there's going to be a success rate on that. But even if it's a 10% success rate across 100,000 people that are working year on, year out, year end to get those conversions, that's going to be our growth. And that's going to be different than Microsoft and Amazon that have built up massive distribution teams because they were first to market with cloud.
Ooh, I have a question for you. Since given a conversation I had a couple of days ago, let's say a very big software company, B2B, like Palantir, wants to sell, and they have these 2 channels, or direct sales or partner sales like PwC and so on. Let's say for an established B2B software company subscription, what's the percentage you expect the partner channel to actually contribute to the sales?
Your question is, what is the percentage that the channel partner like a Carasoft will contribute to a Palantir?
Exactly. Well, for a general, like for an already established company, and then how you expect that to be different for Palantir. Obviously, we don't know the percentages, but it would be nice to have a reason.
Because I have no idea how Accenture, PwC, or Carasoft are selling their product. Like, it's
That's
hard
why we don't have any direct number, but no, like let's say a big company like Microsoft, what percentage do you expect?
Oh, do I think that third parties are helping them? I would imagine at least 30, 35%.
Okay.
You know? I think if you add up all the third-party distribution partners a Microsoft or Amazon has, it has to be at least a third of their sales are not coming internally from them. It's coming from these third-party vendors that are helping them.
Okay, I would not disclose the company that I was referring to, but I was said north of 80-90% of the sales were coming from the partner channel, which means that only 10-20% of the sales were coming from internal sales of the company selling this product. I personally think Palantir is actually on the opposite spectrum. Because
go ahead.
Because these considerations that we mentioned, like Palantir is so small that if you were already had these, let's say, PwC, Deloitte, like these big guys with 100K people actually selling Palantir, given the relatively small size of Palantir, we would see stronger growth than 20-30%.
Right, 100%.
So
so basically what you're saying is we haven't tapped into these third-party channels at all yet.
That's the feeling I have.
I think that's right. I think that's accurate, yeah.
Because let's say, now let's reason as if we were a consultancy. Like we are these consultancy guys. We are a center, okay? You partner with Palantir. You partner with me. Okay, great. Nice to meet you. Would you trust me in the first month that we hang out together? Like, how much time would you take for you to trust me that I can direct my horde of people and consultants and my reputation on the line to actually start pushing you? Like,
there's not 1,000 code straps. That's your point, right? Because CodeStrap is the guy at PwC that's building Palantir out for all these enterprise. We don't have a lot of them.
This until the company is actually confident in say, whoa, wait a second. This stuff works. This stuff really sells like a weed, no, like a hot cake, you say. Like once you have that, then you start having, you know what? We partnered 2 years ago. Like how long? Like I personally think like when the partnerships with Accenture and so on were announced, my expectation was, oh, now we grow. But the
Right.
reality is maybe this channel partner is just was just on the testing side.
Right.
And as a consultancy company, you are actually incentivized to say you are a potentially good candidate for a partnership. Let's make a partnership. Like we test you. If you pass this testing period, it's like you hang out with a girl and you don't marry her in a day, maybe at Las Vegas. But normally, I would say it takes 2-3 years to get trust. Makes sense?
Not unless you're drunk. Then it takes 2-3 hours.
Yeah.
When you're having
And
some fun.
what do you drink, Amit?
Jack Daniel's honey. You guys know this. The only drink I know. That's it. It's the only drink I sound smart when I say that, but like that's the only drink I know. No, I think you're making a good point. Like Accenture, that partnership, we talked about it on this podcast in 2022, and nothing has really happened to our knowledge from that partnership or the Caresoft partnership because, yeah, you're right. It takes time to build that out.
How many people are Accenture employees?
Dude, Accenture has to have like 100,000 employees, something like that.
So 700,000. So 700,000 PwC employees.
500,000, 300,000,
300,000.
Damn.
And these are just two. So let's say there are five partners. Like, what are the partners?
Deloitte has 450,000. Good.
Like, what are the disclosed partners so far? We have Caresoft, which is relatively smaller, but we know that they were running also pilots or something with BCG and McKinsey. So if you combine the existing partners potentially selling, okay, not everyone is in IT selling software, but let's say a 10-20% of these people, these already million people, that is a huge sales force. So
yeah, I agree. Coach Rep here in the chat says every good technology company leverages platform engineering to scale product engineering. Luckily, this is what I've been doing for the last 20 years. Given the money, I will scale massive value creation. I think that's also why he's been talking about this developer community, because if all the developers are telling the Accenture consultants, hey, we want Palantir, that gives the signal to the Accenture top guys that we should keep pushing Palantir. And then it becomes a beautiful a scale that goes up into the right, which is what happened with Microsoft, Amazon, all those guys. But it took time to get there.
Well, this essentially means that there is this huge co-option that potentially can be executed. We don't know if it will happen, but we know that there is there. Like if this is true, that this 20-30% CAGR that Palantir achieved so far was done essentially on their own, it means that if they also have the real support from the partners, we could see some very good numbers.
We got Cube in the chat says, I'm a consultant at Deloitte in data and analytics practice. I got to work with SAP and Snowflake. Let me find, we got a Palantir team. I'm asking to switch teams. So the consultants want to, they want to work on it too. We just got to give them the opportunity. All right, let's do this last question. Or Matt, give me your thoughts and then I'll do the last question. Go ahead.
No, I all I know is that I've asked, I understand how this piece works, right? I have a friend that works for E&Y and previously worked for PwC, and they kind of they look for opportunities to set. They basically hire E&Y to come in and say, we need a some sort of platform that allows us to do X, Y, and Z. And with that, you know, they could easily say, well, we've utilized Palantir in this sort of organization or that sort of organization, and it allows them to help implement that sort of infrastructure within their company. So I get that piece of it. What I will say is, and I don't know specifics around this, is my friend, I asked him straight up, I was like, what exactly, he was telling me about one of the projects, right, that they were working on. I won't say specifically, but they were basically looking at infrastructure in a major metropolitan area within the United States. And I said, sounds like you guys need to use like a Palantir Foundry or a Gotham or something like that to be able to help. And I sent him some videos. He's like, this is exactly what I need. This is exactly how I need to set it up. This is the infrastructure that I need. the operating system that I need, rather than infrastructure. And having this sort of ability to monitor all this data would be extremely useful. And they actually went up and asked some of their management, and they said, we cannot work with Palantir because they are currently the auditors and accountants for Palantir. And so at least that's what my interpretation of
Sorry, could you repeat,
thought
please?
was. That they cannot utilize the Palantir software because it would be a conflict of interest, because they are also, from what I understood, the accountants and auditors for Palantir. Right?
Okay, so that's
yeah. So like,
okay.
just like how UDoc at the moment can't, I think we also can't use E&Y for consultants. We would have to bring somebody else in because they're currently our accountants, right? So that piece was kind of interesting, but it goes to show you, at PwC or Deloitte or any of these other companies, exactly what you're talking about, Arnie, which is they basically say, hey, you guys are normal consultants with respect to X, Y, and Z, and what do you work on? What have you seen work in the past? What have you? And it's pretty interesting because I've observed something in the oil and gas industry where you'll see these big changes happen at one company, and we all hire the same consultants in the oil and gas industry. And so then 6 months later or a year later, it's like, oh yeah, we just implemented that as well. And then it's 6 months later, it's like, oh, we just implemented that as well. So it's all the same sort of management styles and stuff. They all kind of like hop around, and everyone's like, I have a brand new bright idea. It's like, no, you just did it at the other oil company, and now you're just. So it's that's a positive thing, right? So agreeing with what Arnie had said. So Amit, I'll hand it back to you.
Sorry, I would underscore a comment that Codestrap shared. I'm focused on applying Foundry in private equity. 1. M&A is accelerated with Foundry. 2. Intelligent operations with AAP will grow the bottom line and valuation for the firm, tech multiples. The funny thing is that years ago I thought, imagine if you are a Berkshire Hathaway and you have Foundry, you can implement it to all the companies, how many synergies you can apply. Like Berkshire Hathaway are all legacy companies. Potentially, if you can digitalize them, you create 80 software company on legacy industries. But what Codestrap mentioned about Foundry accelerating M&A is actually the first use case that made me understand what Palantir was doing. Now they don't share it on the website, but on the old website, which was kind of weird, incomprehensible, this is the only thing that I understood. They were having this like a Foundry for M&A, and they explained the use cases. And having worked in investment banking, I saw, I was not in M&A, but I talked with many guys and also M&A consultancy guys. Essentially, what happens is the banks make the deal making. So when you are in investment banking M&A, you sit on the table with the client, you try to finalize the deal. And your job is essentially Excel to make the model, the PowerPoint to convince the people, and then the documentation that is done with the law departments. Until here, all the M&As are always very nice, perfectly rational, because an M&A guy, like a finance guy, doesn't have a real sense of the operations. What he does is calculate synergies based on Excel, estimates by the management, but they are kind of detached. Imagine this component already done already internally by using Foundry, creating a digital twin of the target. That is something that would be extremely more reliable from the acquirer perspective. But this was not something that was mentioned in the website. What was mentioned in the website, which I know that is actually a very big problem, long and very big problem, is until you send the document, M&As are great. Everyone is happy. The big problem comes when after the merge, because after the merge, you have two companies that don't talk to each other, and you need to make them talk.
Yeah.
And making them talk it's not only a matter of you take a column of database, your column from another database, and you merge. You need to make them speak. You need to make a lot of management talks to actually align, okay, how we actually keep these documents all together, what are the priorities, how we show the data. So basically, essentially, from one database to the other database, how we merge the two databases so that the finalized database is actually better. And to do this, guess what? You have M&A consultants. So people working in consultancy companies like PwC, working for 1 year or 2 years, just integrating these databases.
Yep.
And Palantir accelerates that. Like, if there is one thing Palantir seems to be very strong is the data integration side. So if you can do with software what you need with a full team of M&A consultants for 1 year, 2 years, that's a huge cost saving. And you know that the output would be potentially better. So thank you, Kotsra, for sharing this hint.
That's a great example. That's a phenomenal example. And again, to an extent, that was also my investments thesis in 2021. I didn't have as comprehensive of an understanding of that example as you did, Arnie, but my basic elementary thesis was I think this software can be applied everywhere. And when Karp says we want to be the most important software company in the world, you get into so many different subsections of that. But at the core level, you're like, okay, well, most important software company in the world, whether it's defending Ukraine or making M&A way more efficient, that's something that I want to be part of the future for. And, maybe Palantir can be that company.
If we go more philosophical, to be the most software company in the world, you need to be the software that creates whatever software. And Palantir proves that it can do that.
And that's why, I think that's why we are doing this podcast about them. That's why we really want to invest in something that's real, which is sales you can figure out. But it's really hard to figure out the part Arnie just broke down. That's the harder part. All right. I think that is it for us. This was a great episode. Thank you, everybody, for being here. Coach Strap, thank you for being in the chat. You really, really helped us work through this intellectual thought project that we're on. So thank you for that as well. Thank you, everybody, for joining. Arnie's Twitter is in the description. Matt Money's Twitter is in the description. Please make sure to follow us on Twitter. If you're not on Twitter, make an X account. Support free speech. Elon's trying to take on mainstream media. I think everyone should support him. Pay the $8 a month. It's $8 a month to have free speech. It really does matter, in my opinion. So, and there's a ton of Palantir updates, like 24/7, and all of us have pretty good accounts for that.
I would say the fastest updates.
The fastest updates. Yeah, I really do think if you're not on X right now, you should make an X account tonight and just check it out, because if you care about Palantir, the information's there, and there's not that many social media platforms that are actually trying to allow people to speak. Matt, any last words?
No, I just want to say thank you, everybody, and really looking forward to a prosperous 2024. I think we're going to learn a lot about the company, and with that, I hope I eat a lot of my words, and I hope we do get to the 25-30% growth rate again. And at the end of the day, I still think that this is a phenomenal company. I'm fully invested. I've never sold a share, and very excited where we'll be 15 years from now, and I anticipate this to be the most important software company in the world.
I love it. Thank you, everybody. We will see you next week on Palantir Weekly, episode number 105. Bye, everyone. Have a good weekend.
Thank you. Bye.